Hello everybody and welcome to your second lecture. In this lecture I am going to help you into reading candlesticks, explain the psychology behind them and how to recognize some patterns formed by these candles. What we should understand when we talk about candlesticks is that they are a way of communicating information about how price is moving at a certain period of time. That can be years, months, weeks, days or even minutes. Candles refer to that information for a specific unit of time. In this example, I am on the daily chart for Bitcoin, and thus each candle represents the open, close, high, and low price of that given day. This horizontal axis at the bottom of the chart can be used to understand which day corresponds to which candle. The color of the candle is also significant in understanding whether the open price was higher or lower than the close price. If the candle is red or denoted as bearish, that means that the open price is higher than the close price, which is lower, and if the candle is green or denoted as bullish, that means that the open price is lower than the close price, which is higher. The ability to read candlesticks allows the price action traders to become very good strategists, taking into account the behavior of other traders and large-scale market movers. In other words, candlestick patterns help traders calibrate their own trading with the fluctuations and reversals of larger, more influential participants in the market so they can participate into significant price moves as well. Now let's take over some examples of how to read candles. Here I have two examples of candles, one is green and one is red, and we are gonna go over each one of them and I'm going to explain how to read them. When you see a green candle, you read it from the bottom to the top because green candles are moving to the upside, and for a red candle is the exact opposite. You read it from the top to bottom because red candles are moving to the downside. At each candle you can see that we have some annotations and I will explain how you can determine that information as well. Let's start with the green candle. This green part of the candle is called the body. And we call this the body of the candle because it is in between the open price and the close price. This open price here is determined by the fact that here is the price where the previous candlestick closed. And now, because this is the next candle, the open price will be where the body of this candle starts to form. For the close price, let's assume that this is a 5-minute candle, and after 5 minutes are consumed, where the price is in that moment, there will be the close price and the next candle will start to form at that particular price where this candle has closed. Now that we established how open and close prices are determined, we are going to look at the wicks of this candle, which are telling us the highest and the lowest point of the candle. So the upper wick is telling you where was the highest price for this candle, and the lower wick is telling you what was the lowest price for this candle. Okay, so let's assume that this candle had no wicks at all. In this case, the highest point of the candle will be at the same price where it closes, and the lowest point will be at the same price where it opened. When you see a red candle, you read it from the top to bottom because red candles are moving to the downside. The body of the red candle is also in between the open and the close prices, and now the open price for this candle is here at the top, and the close price is at the bottom here where the time has finished for this particular candle. The wicks of this candle also represent the highest and the lowest point of this candle. Here at the top, this wick shows the highest price where this candle was, and this wick right here on the bottom shows the lowest price where this candle was. Let's also assume that this candle had no wicks at all. In this case, the highest price of this candle will also be the open price, and the lowest price of this candle will also be the close price. Now I would like to take you through some candle examples and to explain where we can find these types of candles and what is the psychology behind them. Up here I made a note about what bulls and bears mean. As you can see, the people that buys are called bulls and people that sells are called bears. So when you read or hear that a candle is bullish, that means that people drove the price up. And when you hear about a candle that it is bearish, that means that people take profit and moved the price down. The first type of candles that I would like to take you through are these long bullish and bearish candles over here. Long green candles show strong buying pressure. The longer the green candle is, the further the close is above the open price. That indicates that the price advanced significantly from the open to close and buyers were very aggressive. After extended declines, long green candles can mark a potential reversal or support level. Long red candles shows strong selling pressure. The longer the red candle is, the further the close is below the open price. That indicates that the price advanced significantly from the open to the close price and sellers were very aggressive. After a long upwards movement, a long red candle can signal a reversal or mark a future resistance level. After a long decline, a long red candle can indicate that people are panic selling. The next candle that I would like to talk about is the hammer. The hammer is a bullish reversal pattern that forms after a decline. In addition to a potential trend reversal, hammers can also mark bottoms or support levels. The low of the long wick implies that the sellers drove the price lower during the time of this candle. However, the strong finish indicates that the bulls regained control. While this may seem enough to enter a buy positions, hammers require further bullish confirmation from another candle with high volume. The next candle that I would like to talk about is the hanging man. The hammer and the hanging man may look exactly alike, but have different implications. Both have small real bodies, green or red, long lower wicks and short or non-existent upper wicks. The hanging man is a bearish reversal pattern and can also mark a trend reversal or a future resistance. Forming after an uptrend, a hanging man candle signals that the selling pressure is increasing. As with the hammer, hanging man requires further bearish confirmation before entering a sell position. Such confirmation can come as long as a red candle with high volume. The next two candles are inverted hammer and shooting star. Both of them look exactly alike but have different implications based on previous price action. Both candles have small real bodies, green or red, long upper wicks and small or non-existent lower wicks. These candles can mark potential trend reversals but require confirmation before entering a position. The shooting star is a bearish trend reversal pattern that forms at the top of an uptrend. A shooting star can mark a potential trend reversal or resistance level. Bearish confirmation is required after shooting star has formed, and it can take the form of a long red candle with high volume. The inverted hammer looks exactly the same as the shooting star, but it forms at the bottom of a downtrend. After a downtrend, the long upper wick indicates buying pressure. However, the bulls were not able to sustain this buying pressure and prices closed well off the high and creating this long wick. Because of this failure, bullish confirmation is required before entering a buy position. An inverted hammer followed by a long green candle with high volume can signal a bullish confirmation. The next type of candles that I am going to show you are doji candles, and these ones have different types of forms. Dojis are important candles that provide information in different types of patterns, but we will discuss patterns in a little bit. Dojis are formed when candles open and the close is at the same price. This type of candle has a very little body or non-existent. The length of the upper and lower wick can vary, and the final candlestick looks like a cross or a plus sign. Any bullish or bearish bias is based on preceding price action and future confirmation. Doji candles often implies indecision in the market. The long-legged doji have long upper and lower wicks that are almost equal in length. These doji candles reflect a huge amount of indecision in the market. After a crucial battle between the bulls and the bears, the end result showed little change from the initial open price. The dragonfly doji form when the open, the close and the high are equal and the low is represented by a long wick to the downside. Dragonfly doji indicates that the sellers were in control and drove prices lower during this candle, but by the end of it, the bulls regained control over the bears and pushed prices back up to the opening level to the candle's high. After a long downtrend, a dragonfly doji could signal a potential bullish reversal or bottom, but after a long uptrend, a dragonfly doji could form a bearish reversal or top. Bearish or bullish confirmations is required for both situations to enter a position. The gravestone doji form where the open, the close and the low prices are equal and the high creates a long wick to the upside. The gravestone doji indicates that the buyers were in control and drove the prices higher during this candle, but by the end of this candle, sellers regained control and pushed the prices lower to the opening price. After a long uptrend at the top, this candle indicates a failed rally and a potential bearish reversal. Bearish or bullish confirmation is required to enter a position. In the next section, I will show you some patterns to be aware of when you see them on the chart. The first pattern that I want to show you is the tweezer pattern. These two candlestick reversal patterns appear as either the tops or bottoms of trends in which two consecutive candlesticks share either a high or a low but represent movements in opposite market directions. In the case of a tweezer top, the first bullish candle forms in an uptrend and closes near the same level as its high, which then becomes the high of the next candle which moves bearishly downwards. A tweezer bottom is the opposite, where an initial bearish candlestick continues to downtrend, closing at or near a new low, which then becomes the low price of the next bullish candle. Tweezers indicates that once prices reached a significant level, the top or the bottom, there was a transfer of dominance between the bulls and the bears. Three white or green soldiers is a 3-candle bullish pattern that implies a reversal at the bottom of the bearish trend. These candles should all be strong, bullish, with small wicks and close near the top. These high closes imply a strong reversal from bearish to bullish market sentiment. 3 black or red crows is the opposite of 3 white soldiers and it signals the reversal away from the bullish control at the top of an uptrend. It consists of 3 consecutive bearish candles. In the last part, I will discuss about bullish and bearish engulfing patterns. The bullish engulfing is a pattern where the real body of the bearish candle is overwhelmed by the body of the next bullish candle. This indicates an increase of activity from both bears and bulls and a shift of overall market sentiment towards bullishness. If a bullish engulfing pattern appears in a downtrend, it can suggest a shift in price trend. Bearish engulfing is the opposite of bullish engulfing pattern, where the body of a bullish candle is overwhelmed by the body of the next bearish candle. This also indicates an increased activity between the bears and the bulls and a shift of market momentum towards bearishness. This pattern can be found often in uptrends and it implies a shift in trend. So thank you for being here with me and I will see you in the next lecture.